wherever you move and talk, we'll be fine. All right, all right, when you are. All right. All right, everyone, thank you for coming today as part of our UW FinTech Pitch Speaker Series. I am proud today to have Dennis Joyce from Tacoma Venture Fund to give us a talk today and answer a lot of questions, have a very interactive session about how to ensure that your FinTech idea is investable and best practices when giving your pitch from the venture capitalist and investors' point of view. Just a quick summary about our competition again. This is a collaboration thanks to Sound Credit Union and the Milgard Center for Business Analytics, in which we are looking for ideas from UW students across all three campuses for a new idea, a new piece of financial technology that is going to help people or businesses better manage their finances or engage in financial decision-making with more confidence. So our competition is currently open now, and we are accepting submissions until April 30th. I'll post a link to our website where you can submit your idea via a lean canvas model. And we will select 3 finalists to have an opportunity to actually pitch your idea in front of a group of leaders of Sound Credit Union, community partners, and potential investors. And the winner with the best idea from your pitch will receive $2,500. So that being said, I will go ahead and turn it over to Dennis. Thank you.
Thanks, Michael. And then is there going to be a Q&A opportunity for the Zoom people to write in their questions and then ask them throughout that?
Yeah, absolutely. So for those on Zoom, feel free to go ahead and put your questions in the chat and we'll be moderating that. And I'll let you know when we have them.
Great. And then how long are we do we have the room for?
Yeah, we have the room till 1:30.
All right. Guys, it's great to be in front of you all. I really appreciate the opportunity, Michael and Jen from Sound Credit Union. So thank you so much for the opportunity. This is geared towards a lunch and learn to learn a little bit more about early stage investing, angel investing versus venture capital, and the work I do at Tacoma Venture Fund. Just to get everybody orientated, you know, it really brings me joy to see everybody in the room right now because I started off really curious about venture capital investing back in the late 90s. Hopefully, I'm not aging myself too much, but you know, I was living in New York City and I was really interested in, you know, I would read all these nonfiction stories in like a Forbes magazine or a Wall Street Journal about a company that had gotten started, and this was back in like the .com days where a company would IPO and they would go from like $10 a share to $150 a share, and then of course there would be this article where it was like the venture capitalists that invested in this company 2 years ago, you know, their $1 million investment is now worth $1 billion, and I would be like, well, who's that guy that invested in that company a year and a half ago? I want $1 million to become $1.5 billion. So the idea of venture capital became almost like a lifelong study. And, you know, then you would read these articles and they would always tell you these lies about the venture capital, you know, they found this company in a garage somewhere and then they just threw $1 million at them, and then a year and a half later they're all billionaires, private jets and all that kind of stuff. So that became kind of one of the sort of fictitious things that I wanted to be involved in because, you know, I was always interested in how an idea or a story started and then how it kind of took off. It was always really exciting to me. I was always an entrepreneurial type of person. And, you know, I had everything when I was in college. I was like a DJ, you know, or I had a t-shirt business selling out of my dorm room, or, you know, just all these other things where my buddies would come up to me and be like, you know, I really like to do this, you know. And I was like, well, that's cool. You know, I don't really want to do that, but I would love to see you take off with that. Or, you know, I went to a college and I was a radio DJ, and this football player at my school was like a really good rapper. And so I had a show, and I like put a microphone, and he like blew me away. I was always just inspired by people's creativity and inspired by people being able to like put themselves forth. And when I realized like a lot of times, people just really need that encouragement, or they need that support, or they need to unlock some things, like they need some things financially. So throughout my professional career, I've really been on that journey. I worked at a VC firm when I was in business school. I got my MBA. I kind of understood that financial thing. I was involved with real estate for a lot of years. You'd get involved with a project and you would say, oh, well, this building needs to be rehabbed. And in order to get my money back, I have to resell this thing. So I have to put all these great bells and whistles into the building and knock down a few walls, put some countertops and stuff like that. And then I can resell it. I can make a huge profit off of it. Like you tell these stories to yourself, and then you go, well, why don't we just do that? How much do I need to get started? What do we need to put into that? And how do we ensure that we are successful on the other side of it? And then as I moved forward with that, a buddy of mine came up to me one time and he wanted to make a movie. And I would be like, well, I don't want to make a movie, but what would you need in order to make that movie? Well, I need $5,000 so I can rent some cameras and start some interviews, and then we have to get into film festivals, and then we could probably make some pretty good money if we got it to DVD, etc. And so I was like, well, I got $5,000 to lose. Why don't you go get your cameras and get started with it, and then let's measure this thing along the way. So I was always really, really curious about those types of things. About 10 years ago, I had really had some success with the movies. We got a few onto Netflix and film festivals. We won a bunch of awards, but it was always kind of stressful for me because movies weren't really making any money. And you found out that these film festivals are just, they don't really like pay you back. And you kind of have to be in Hollywood if you want to make money in the film industry or in the entertainment industry. That's really where you need to be, is you need to be there. And I was like, well, I don't want to move to Hollywood. But I live in the Pacific Northwest, and a lot of people are investing in, tech firms and all these types of things. So I started going to some of these events, events like this, and you see these pitch competitions, and it was really exciting to me because it brought me back to where I was in business school and back to where I was at the original phase. And I was able to see companies, pitching themselves, and the ones that I like, I could follow up with. So I really dove into the world of angel investing. Now, for those of you who don't know, angel investing is where, people invest their own capital in early stage companies. In the Pacific Northwest, they have these angel groups. And it's actually pretty simple when you really think about it. I liken it to almost like joining a gym. You pay like $1,500 per year in order to get to the angel groups. And then you meet with them on a monthly basis or a semi-monthly basis. And what they do is they weed out all of the ideas, and they kind of will present maybe a third of them to investors. And so investors are able to kind of pick off the ones that are most investable or most relevant to them. And, it's a nice system. So there are a few organizations in the Pacific Northwest that are angel groups. Every ecosystem throughout the country has them. In more active areas like in New York City, Los Angeles, Silicon Valley, Boston, Austin, Texas, Chicago. They have a lot of different angel groups. In the Pacific Northwest, we have a few. One of them would be Alliance of Angels. If you're looking to raise from angels, you have an angel group, you would go to the Alliance of Angels, you pitch your idea to them. They look at probably 30 to 35 per month. Then they present about 8 of them to a broader group of people, screening committee, and then they will send probably 3 to their constituency of about 150. So every month they're looking at 35 ideas and they're picking 3 to send through. And then of those, maybe 2 of the 3 can raise some significant capital. So lots of different opportunities throughout the country. Seattle has groups like the Alliance of Angels. Then there are individual angel investors. Individual angel investors are high net worth individuals that invest their own personal money. And you can meet them anywhere you can find them. It's probably more standard to meet a group of angel investors tied to a technology sector. So you will see a lot of angel investors that probably worked at like a Microsoft, or people that are currently still working at a place like Microsoft or Amazon, or Meta. And so that's why there are a lot of angel investors in Seattle. There's tons of angel investors in Silicon Valley and the Bay Area as well. There's a few angel investors in Tacoma. Typically, they're ultra high net worth individuals that are very mission driven towards building the entrepreneurial ecosystem of our region. It's not always obvious where to find them. And so you really kind of have to network well in the area in order to find angel investors. So then the next phase of investor is a venture capital investor. And that is what we are, and that's what I am at Tacoma Venture Fund. I started off as an angel investor, investing my own personal money. You know, an angel investor is usually investing between $25,000 and $100,000 of their own personal money into a company. They have to find their own deals, they have to find their own startups, and then they have to be able to take that risk. Now, a technology company is not going to be able to do too much with $25,000. So you're gonna want to syndicate with other people, so then you're working with other angel investors and you're trying to like collaborate. So maybe you have 5 angel investors investing $50,000. That's $250,000 into a company. And if your cash burn is $25,000, maybe you have 2 employees plus some expenses, that could be, you know, $250,000 could be almost a year's worth of cash runway for a company. It's a good solid amount of money, and it gets a founder a certain distance towards their idea and their path. So you can see how we're sort of adding resources together in conjunction, and that's why an angel group is very valuable. Now, a venture capital firm is a little bit of a step up. We operate out of a blind pool of capital. We at Tacoma Venture Fund are in our second fund right now. Our first fund, we raised $12.5 million. We raised it about 5 years ago, okay? And then we take a management fee from that, pays my salary and allows me to do this work for a living. Not a lot, but a little bit, enough to be doing this. And then we invest alongside angel investors. We'll invest alongside angel investor groups, and we will also invest alongside other venture capitalists. Our typical check size is about 10 times as much as one angel investor. And the purpose of that is we want to make sure that we have a scalable solution so that when we write a check, we are giving a company about a year's worth of runway in order to execute on what they are telling us that they want to do. So the way we sort of think about it in terms of working with an angel group is, hey, we'll put in $300,000 or $400,000 in a company. You guys could put in $200,000 to $300,000 or $400,000 in your company, and now we have 2 years worth of runway at their burn rate in order to really understand where this company is going. And we put the money in today, and we work on it for those 2 years, and we determine where they are. And we're trying to figure out, are they going to be profitable? Are they going to have sales? Are they going to be really successful and raise additional capital to grow it more and more? Or are they going to position themselves to exit? And they can exit through IPO, acquisition, or sort of future investment from private equity or other sort of things to go. Now, this is it's an incredibly risky asset class. So the exit is not always guaranteed. But when we get involved early, we are hoping for it to drive towards an exit. So I will pause there for a second and just like breathe for a minute so that you guys can kind of digest the idea of the distinction between sort of what angel investing is versus venture capital. Do we have any questions at this early phase?
Do we have any questions on Zoom? Feel free to just say your question, or you're welcome to put it in the chat.
Well, they can put it in the chat. They can just put it in the chat.
We'll do the chat. Yes.
So how do you like get your returns on your investment? Is there like different modes? Like in shares, we have like a continuous stream like debentures or like equity. So when it comes to investing in companies, like is there any difference of being a venture capitalist versus an angel investor? Like when do you get your profit on investment?
I love it. I'll get that in 2 seconds. I'm just gonna head right into the next phase, and then we'll that answer will come in sort of how we do it. Okay. So a venture capital firm is what I would call a double-sided marketplace. For those of you that are involved with like economics and stuff like that, you understand that in a double-sided marketplace, there are people that invest in TVF, and then we deploy that capital after taking our management fee. Okay. I have a fiduciary duty in running Tacoma Venture Fund to provide a return to the investors that, trusted us with their capital, okay? So when we make it, basically what we're saying to them is, you're a high net worth individual, you have, dreams for return on your capital, or you wanna put things into the ecosystem, or you wanna grow businesses in your area, or in some cases, you're an ultra high net worth individual that gets hit up all the time for investment. You might be working another job. You might be the president of a company. You might be like a real estate investor. You might not have time to perform due diligence in, an early stage company. Maybe you've been asked by a nephew, hey, I have a startup in AI or crypto, will you give me $100,000? So a lot of times, an ultra high net worth individual or high net worth individual wants to be involved in venture capital, but they don't really want to actually do the day-to-day, administration and work. So we are a really good platform for that because, I'll find you deals. I'll be able to look at your deals. I'll be able to analyze which companies are investable versus which companies are not investable. I can provide you with due diligence and write-ups and notes on the companies that we like. I will look at your company, but then I will give you also another 25 companies to invest in that will spread our risk out, so you don't have to do that legwork. So we provide that service to our limited partners, right? The other thing that we provide to the companies that we make investments in is, we are able to help them syndicate their deals. We're able to give them notes. We're able to provide them with best practices. The other thing is we provide a layer of accountability to that company because we can help that company think about, where they want to go with their next phase of development of their product. We can help them strategize, and we can also introduce them to other investors. So we're a double-sided marketplace as far as that's concerned. Now, angel investing and venture capital investing can work with each other, or they can be completely independent. Every VC firm is different, and I can talk broadly about some VC firms, but I'll probably focus most of my discussion on like who we are as VCs. But some VCs are all about like earliness. Like I see deals day one, when, I'm going to all the events, I'm living in coffee shops, If some great engineer from Microsoft or Amazon has a great idea, they're gonna come to me first. And then I will be able to make a decision on whether to invest day one. And they will use their capital in their platform. You know, a lot of them are around the same size as TVF, so they'll maybe invest like, you know, $200,000 to $400,000 in a company. And day one, that founder and that founding team will have raised some cash. Another place to go early is to angel investors. And a lot of that will happen through a networking situation, like, well, you know, I got this idea of an AI bot that allows, you know, robots to blah, 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 blah. And I'm an alum of Microsoft. So I'm gonna pitch to my manager, who is, you know, a veteran and of Microsoft, and they'll be able to give me, you know, $25,000, and they go to a country club and they can get a few of their friends and friends of friends and friends of friends. And that tends to be what some people call a friends and family round. Now, I don't like to really actually talk too loosely about friends and family because I don't have too many billionaires in my family, you know what I mean? And I don't have a lot of friends that are billionaires, but you know, that's kind of like the sort of the casual way that people talk about that. So the first phase is to really, you know, sort of use their network and to do that. And if the idea is really starting to catch steam, it will then attract venture capital interest, and they may be able to get some early checks. And there is close to a dozen, if not more than that, early stage VCs in the Seattle region to choose from. Now, Tacoma Venture Fund usually comes a little bit after first check. We are process oriented, and we are trying to hone in on the opportunity that we can understand and that we can measure. So usually we are not the first person you speak to when you are raising your capital. You're trying to either go to a very, very, very early stage group. You're trying to use that network exercise, and then you're trying to measure that over time to determine what you found that is working. And that's when you would sort of engage a group like us. Now, sometimes I speak in examples. So I would say that we've just invested in a company that is making makeup. It's like a Keurig for makeup. And I met with them last year. And I did multiple meetings with them last year, and I love the founder. She was just incredible. She had a great co-founder. They had designed this thing from a pilot standpoint, and they had all these followers on Instagram. And I was like, yes. I still need to sort of see a little bit more evidence that this is going to be, you know, exactly the way you want it to become. I kind of sort of let it go. But I really loved the idea. That was last May. They re-engaged, or actually I found out I re-engaged with that company back in March. And I found out that that company had found a deal lead for the project. That deal lead was like over the moon enthusiastic with it. Their previous investor from a year ago had decided that they wanted to put more money into it. And they got one of the sharks from Shark Tank to commit. And they had over 10,000 pre-orders for the product just on their Instagram page. So number one, I was able to realize that at least 3 other investors, including a billionaire, was interested in that company. So other people agreed with me that that founder was incredible. And then there was over 10,000 people willing to spend over $300 on the concept. So we have something. Now, I could have invested in that a year ago, but I would have just been sitting there for the last 12 months going, I hope this company gets somewhere, I hope this company does something. But instead, I really just sort of, I took the meeting, I tried to understand what was going on with the company, I tried to develop a love for it, and then I just sort of kind of like kept tabs on it. And then when the company reemerged to me, there was all of this evidence that we have something. And so that was sort of my opportunity to really take things to the next level and get involved and to really analyze that. So a venture capitalist or TVF is usually like just a little bit behind the time. We are not too concerned about missing out on like the greatest opportunity today. We are trying to hone in on what we know right now about the company that we can build upon. And it's an important distinction for us because we are using data, and it could be pre-orders, or it could be sales, or it could be customer pricing, or it could be, some other, analytic that you're using for us to determine that that is a great opportunity for us to, make an investment. And that's what we're looking for at the end of the day, is we are trying to provide outsized returns for our investors. And therefore, we have to find companies that have really kind of hit on something that is really attractive. Okay, good answer? All right. Before I dive deeper, does anybody have any other questions based on what sort of I'm talking about?
So you explain your approach as kind of being a little bit later in the investment process. Can you tell me a little bit more about the risk reward process or the thought process from TVF in those moments?
Yeah, so, well, I'm gonna use that kickoff to get into a question that Michael asked earlier. So I'm gonna put my eyes on and get to it. Okay. So when we are looking at a pitch, first of all, I'll take 5 steps back and say, like, we are usually digesting like a pitch deck or a pitch presentation when we are analyzing a company. And for those of you that are in like a classroom right now, it is a really, really simple concept. And I think that it's important to just really kind of like get an idea of like, what do we need to see just as a baseline? And we need to see who, what, where, why, and how of a company. We need to see a 10 or so minute presentation of what that company is. We need to understand what the product is. We need to understand like who the team is that are building that, the product. We need to understand the marketplace. We need to understand like the strategy of getting to market. We need to also understand what kind of capital is needed, how much you guys are raising, what needs to be done in order that, and then we need to understand what the plan is moving forward and where you will be after you use all the funds, okay? And so a key component to it, in the who is the team. That could be just yourself, but what's more important is to understand like who else is involved with this movement, okay? It could be a founder, it could be a co-founder, it could be advisors, it could be other investors. In fact, it should probably be all of those things, okay? Because no one can do it alone, right? But, we're probably owning our idea. We're probably socializing that idea with a few people that we want to have, help us move this thing forward. Maybe I'm a technical co-founder and I need a person for operations, or I need a person for sales, or I need a person to help me build out the product, or I need a person to help me like talk to other investors. So we need to understand who that team is. The other thing is who is your advisor cohort, okay? Are you building a fintech company? It would be great to have a CEO of a bank. Maybe they're gonna be a customer, or someone that can implement the product or give you feedback of the product. So that's sort of your advisor cohort. And then as you're sort of thinking, well, I'm a little bit limited, I haven't raised any money yet, I can't afford to pay anybody. Well, it probably will be just you in terms of getting pay, but we need to understand who's helping you from an advisor standpoint. And I've seen the whole entire gamut, but one of the most obvious ones I had a founder that was at an idea phase, and he was convening every Friday his advisors for an hour brainstorming session, okay? And every time he did the Friday call, he basically was giving them work to do. He's like, I need to talk to 5 investors. Can anybody share with me emails for 5 people? I need to find people that could buy the product. I need to find people that could help me build this product. Does anybody know in my network? And he was always cycling advisors in and out, and he was holding them accountable to the Friday call. I think it was probably once a month now that I think about it. But he was doing like a Friday session, and he was making sure everybody showed up to a Zoom call, and he was getting them to basically work for him. And he was at the earliest phase, he was delegating responsibility to people that were deeply engaged. Now, on the other side of it, I see people that are like, you know, our advisors are Bill Gates and Jeff Bezos and da-da-da, da-da-da-da-da. I was like, oh, really? Bill Gates and Jeff Bezos are advising you? I was like, when was the last time you had a phone call with them? Well, I haven't talked to them in a couple of, months. And it's like, all right, they're not really advising you. That's just someone's picture on your pitch deck, okay? So, you need to be thinking like, who is helping you take your business to the next level? Because we as investors are seeing that material presented to us, and we're making an assumption, or we're making that leap to being like, oh, okay, well, like, those are the people that are responsible for taking this business to the next level, or these are the people that are going to be working as a team with us as we take this business to the next level. So we're looking for the team. We're obviously looking to understand the product. TVF is sector agnostic, although other people have specific, areas. Everybody wants to be in AI now. 2.5 years ago, everybody wanted to be involved with crypto. And then a few years before that, everybody was like vertical SaaS or cloud. We try not to limit ourselves to one area or another, because we believe that, great ideas are everywhere. We need to really just understand what the product is. And if something is absurd or obscure or hard to kind of understand, we need to simplify it so that, Dodo Brain Dennis Joyce can understand it, okay? So we have the who, what, where, we are regionally focused, and that is up and to the left, Pacific Northwest. I get stuff from Dubai. I get stuff from Europe. I've seen things in Singapore. People come to us from Silicon Valley looking to raise. We are Pacific Northwest, and I don't mind missing out on the next Facebook if it's from outside of my region, because I have never had any success investing outside of the Pacific Northwest. I've invested stuff in North Carolina. I've invested stuff in Boston. It's just when you're far away, you cannot have that close interaction with them. You just are sending the money all the way out there, and it's like, bye-bye. Here, we want to invest in our region. We want to invest in companies that are building in our region. We want to have a long-term relationship, because at the end of the day, we are going to become family. When we're making an investment in you, you're going to know me more than you want to know me, because that's how connected we will be professionally. But also, when you're having good days, we want to cheer for you. When you're having bad days, we want to be by your side. That's the reason. So the other thing is the ability to understand, what you need to raise. I already know what you need to raise. You need to raise $800,000 at a minimum in order to get 2 years worth of runway, so that you can pay yourself and a couple of team members on the average about $10,000 per month. And I can do the math for you, but basically it's, you need that kind of money in order to know what is working. So, and the math is like 12 times 10 times 3, and that's about $300,000 or $400,000 per year, and you need another $400,000 for the next year. And that $800,000 will allow us to understand through a couple of business cycles where you are going with the product. I see stuff all the time, people going like, I am raising $15 million in order to get things to the next level. It's like, what are you gonna do with $15 million? It's you and another person. Like, what are you spending that money on? You know, so maybe you don't need $15 million. And then other people are capital constrained and they're like, we're raising $200,000 in order to take our business to the next level. And it's like, I love you guys. I'm excited for you. $200,000, you might be capital constrained, but we actually need to like put some serious capital in this so we can build this stuff over time and we can measure it. So we need to figure out a dollar amount that will allow us to take this idea to the next level, okay? And then how are we gonna do it? What are we gonna do to deploy that funds? Like, so it's gonna be paying me and my founders, you know, we need full commitment from a founder when they're doing this. And, you know, we see it all, you know, we understand that people have to get by. We understand that people have to get a job. We understand that people are currently in a gig right now. You know, I'm at Amazon and I don't really know if I want to leave it. That's cool. But what we really need you to do here is like, we need to know that when we make the investment in a couple of months, that you are full-time at this, your team is full-time at this, and you are really, really go, because, you know, we have our limited partners to answer to. So you need to budget out stuff, enough runway in order to get somewhere with this company. So you have to budget out a year to 2 years to really be at this full time. And we understand that it's a chicken or the egg type of scenario, but we at least need to know like what that is going to be. And the other thing is like, what are you going to measure, okay? And TVF has a process. We try to measure 5 to 6 key performance indicators that tell us that this is going to be successful. And we need you guys to deliver that. So you need to understand your company enough to be able to show us where are you going to be in a couple of years. And that could be anything, but I could start us off in the conversation. Say you're telling us that you have 2 customers right now, and you want to be at 20 customers at the end of the year. Okay, great. How are you going to go from 2 customers to 20 customers? Well, we're going to add 1 customer per month. So it's great. You're going to start with 2, 3, 4, 5, and 6, all the way up until you get to 20 customers. Cool. How much are those customers going to pay you guys? They're going to pay us $1,000 per month. Great. So in a year, you're going to be making $20,000 per month. Is that correct? Yes. Cool. How are you going to become $1 billion company? Raise capital is going to get you into it, but you're only charging $1,000 a month and you have 20 customers.
Giving up ownerships?
Well, the answer is there's really no answer to that question. What it is we are asking you to think about that, right? We're asking you to think is what would you need to price your product at? And how many customers you would need in order to grow this company into a successful business, right? The other thing that TVF needs to do is we need to match your expectations with our needs. We are looking for companies, are you ready? That are driving towards $10 million in annual sales in 3 to 5 years. $10 million in annual sales in 3 to 5 years. So if you have 1 customer paying you $800,000 per month, we're there. Let's go, we got this. So all you have to do is find 1 customer paying you $800,000 per month. Or all you have to do is find like 80,000 customers paying you $10 a month or whatever. But we still need to get you to $10 million in yearly sales. So that informs your product, your customer, and your pricing. And usually what we're doing is we're ingesting that data. So how many customers do you need to get us there? How many, what do you need in terms of team? Well, I need these many salespeople and these many developers, and it's going to be me and a co-founder and these people. Great. So you have 5 or 6 people that you're going to be adding over a period of time. Okay, well, where are your sales going to be? I'm going to have these many customers and be selling the product for this amount of money, and that's how we get to $10 million in yearly sales. What is your cash burn going to be? My cash burn is going to be, start off with $20,000 per month. I'm gonna ratchet it up to $50,000 a month, but then we're gonna be driving towards profitability. So at the end of 3 years, we're gonna be at 0 cash burn per month. Okay, great. Well, what are your expenses going to be? My expenses are going to be this amount all the way through. So as you think about your company, you want to measure out those 5 to 6 key performing metrics of your company. And then we're going to be thinking about that and figuring out whether or not there is fit. Can we deploy that capital effectively? Can you drive towards that outcome? And can you get us the capital that we need in order to return that so that we can find a home for your company? And then trust me, if you can get to $10 million in yearly sales with growth and a little bit of profitability, then we can find a buyer for your company. Or you can grow that into growth phase, or we can find additional investors in that company. So that is the long answer to the question, but really at the end of the day, we're looking for a really cohesive story on like what the company is, who's involved with the company, what the product is, what we're gonna be sort of the financial modeling of that, so that at the end of the day, you know, we're able to give it the capital it needs and then find an exit for that company. And we need to see that at the beginning of the whole entire discussion in order for us to move on. So.
We have a question in the chat.
Yes,
Is from Jiang. Sorry, feel free to correct me if I'm mispronouncing your
it's
name.
Jang, yes.
Jiang, sorry about that. Do you only look purely at the business, or does personal history count? For example, a preference for people who owned a business before versus a brand new business owner.
Great question. Okay, so we're hearing the story. We believe you. We want your idea to happen. And we're thinking, what will it take in order for us to, you know, we're going to deploy some capital. Maybe we're going to get some other investors in this company. So we're kind of plotting our journey with you in advance. Now the question is, can this founder do it? And what is going to happen with this founder after we give them $800,000 or $1.2 million or $1.5 million that they're asking for? Can they do it? Now, would you guys give capital to someone who has never built a company before? Or would you feel more comfortable working with a founder that had already raised $1.5 million and grown a company to an exit? It's obvious that someone that has already done this thing at scale, managed a team, hired effectively, deployed capital, budgeted, knew how to be accountable to a boss, it's obvious that you would be giving that to a founder. So does that mean a person that has never raised capital before, can't do it? The answer is no, but you have to understand qualitatively, like you're gonna need a lot of help with someone that has never done it before versus you could, invest capital with a multiple time founder, or a 2-time founder, or a 3-time founder, and you know that they'll be able to understand complicated concepts, deploy capital, hire and fire. So, some investors will say, we do not invest in first-time founders. It just doesn't happen. That the other thing is, like, we've seen multiple time founders, and the question is, well, how many happy investors do you have? Have you built companies successfully? Have you scaled companies before? What happened to the previous company? Why are you back in front of us? Aren't you a billionaire on a yacht somewhere because you were so successful with your first company? So, it's easy to say, we need to invest in people with experience, but you might be actually missing out with a great idea from a founder that just needs a chance. So we look at the problem, or we look at the opportunity holistically. If we're looking at a first-time founder, we're really trying to scrutinize advisors and other investors and team members, because we want to be able to see if we can provide support mechanisms for a first-time founder so that they can build it. And then for a second time founder, we're looking at them and saying like, whoa, how did your first company do? What were some of your learnings? How did you operate with them? Did you guys kind of grow effectively? Were there some challenges? What was missing the first time around that, you want to change the second time around? So we're trying to answer Jake's question, we're trying to understand like the whole entire sort of picture and imagine what it's going to be different. And TBF has made investments in multiple time founders. And I will say that they know how to, get to a level. Like they know how to get from idea to the next couple levels. They know how to hire, they know how to talk to investors, they know how to raise. They've been there and done that before. But we have also invested in first-time founders, and like there's a lot of energy there. They think differently. They have new ideas popping out of their brains. They're really excited, they're really energetic. But what we need to understand is like each group needs to be treated slightly different. Any other questions on that? So we've gone through, pretty much what Tacoma Venture Fund does. The basic elements is we need to understand really what a story is. Sorry, do you have a question?
Yeah.
Yes, go for it.
So, how far in the future would investor look into in terms of deciding the percentage of ownership over a specific amount of capital they're gonna invest today? Like how far in the future, like 10 years, 5 years, or so.
Well, typically, we're just trying to get to the next phase of development for the company. And we're trying to match that with our capability to invest. Some, private equity, Silicon Valley VCs, they might be deploying a Series A investment in a company, and they might already know that their check size is like $20 million cash. And they might already know that they need to own 20% of a company in order for them to, have the ownership stake so that they could get a return for themselves. And you could read like blog posts and podcasts and all these other things that could give you rules of thumb, but we don't really operate that way. We are a micro fund, and our ownership structure is such that we can have any kind of ownership on the cap table. But I will say that, we're going to be negotiating a deal that's fair for us, that can give our fund the return that we need in order to get our investors their capital back. Does that make sense?
Thank you.
Any other questions here? So what are we sort of looking for at the end of the day is we are looking for Pacific Northwest companies that can come to us and deploy, $400 to $1 million of capital and have a solid plan for that. Now, if you're raising more capital, we need a lot of help. It would be, a combination of Tacoma Venture Fund, but then also what other groups will be investing in your company? Will there be other early stage micro funds? Will there be other angel investors in that? And then, where will those source of funds be coming from? The Pacific Northwest has a very robust early stage venture capital system, but there are certain sectors that, are really hard to raise from. And so you might be looking outside of the Pacific Northwest in a certain segment. I mean, and like I said, I've seen everything. I've seen IoT devices, I've seen deodorant, I have seen crypto, I've seen, cloud, enterprise SaaS, everything of mining, apple orchards. We see it all. And so, and we don't try not to discriminate against, we don't do apple orchards. We really don't do apple orchards, but it's more to the effect that we don't understand that segment that well. If you're able to attract other investors with deep knowledge in that industry, it's possible that we can be involved in that. We just have to understand that story effectively. Does that make sense? So, yeah,
I have a question. So in compartmentalizing the different characteristics that you described very well of what you look for when considering making an investment, I'm sort of putting it as the strategic implications, right, about the business, obviously the data that you had mentioned. Is there anything else that you can think of though, aside from that goes into either about the company or the founder? You mentioned developing love, right, for the company. Anything else that goes into that you think of?
Well, you know, if anybody sort of would like to be involved with venture capital, I think critical thinking skills is probably the #1 technique that I use in understanding a company. I need to try to figure out, what is needed, what kind of capital is, and you're only being told the story that the founder is telling you on the idea. And in the founder's eyes, everything is perfect, right? This product has no competition. This is $1 billion idea. The whole world needs this. And we have a product moat that nobody else would ever consider doing. It's like, okay, great. According to that founder, these are the facts. If you talked to another person, they would be like, well, other people are doing it, or there's other, products that are similar, or, they're pricing in a certain way, or, it's actually not that big of a product, or they're underpricing it, they're overpricing it, So we're looking holistically at the idea that is being presented by the founder, and then we are performing due diligence on our own to try to, develop a critical eye on what they're doing. And to your point about, what are some of the things that we're looking for, we are looking for whether or not we want to work with a person. We're thinking about what is our relationship going to be with this individual for the 2-year, 3-year, 5-year journey with them. Some of the people are really easy to deal with, and some of the people are really hard to deal with. And life is really too short to be dealing with people that don't want to talk to you on the phone. Have questionable ethics. We don't want to be working with people that, we don't want to be working with, really, at the end of the day, because we are building a long-term relationship. The other thing is I might be going over to some credit union for a strategic help, or I might be talking to Jen and going hey, this is a product. Can we talk to, your application team and your strategy team to see if this is a good fit for them? If Jen is like, hey, what's going on with this clown that you referred us to, then that's bad business for the work that we're doing, in the ecosystem. So we're trying to we really want to have a virtuous cycle of, partnership with the team. And all we're trying to do is help you execute on your vision. We don't really need to be doing this. We want to help you elevate your business and get your business to the next level. So, yeah. What are some other questions in the time we have that I can help you with? Yeah.
As a college student with low capital, why should I go with venture capital instead of the stock market? The ETFs.
Venture capital asset class is about as risky as you could possibly ever imagine. And the answer is you should not invest in venture capital with money that you're gonna need or you're gonna want to retire on.
That's what
The way for you to structure your portfolio or thinking about investing your portfolio as you guys build your career is, for your investable assets, you're gonna be thinking about real estate, the S&P 500 index fund for your IRA and for your, retirement capital and those types of things. Now, venture capital, sorry, so go ahead.
How much capital would you say to get started in venture?
First of all, most of the people that invest in venture capital have to be an accredited investor, so they have to have net worth above $1 million in real estate and those types of things. So I would just say that. There are angel investor groups or cohorts like AngelList and those types of things. And, this is a day-long discussion on portfolio maintenance, but I will say that as you think about building out your investable assets, think of it as you have to have above $1 million. And then of that, no more than 5 to 10% of that investable capital should be dedicated to this asset class per year. So say you have $10 million in investable assets. You have now dedicated $9.5 million S&P 500 index, yacht, you know, all that kind of stuff. And then you have $500,000. Of that, you should be like, I'm going to use this $500,000 and I'm going to invest that over a 5-year period. And I'm going to invest $100,000 per year. And I'll invest 4 companies at $25,000 per company. And then you'll have about 20 companies in your portfolio over a 5 to 10 year period, and you'll be all set. Easy. And then now you're a world-class angel investor, and everybody in Tacoma will be hunting you down because they'll find out that you're hot to try. You're looking to get some capital out there in the streets. So yeah. Yes.
You mentioned KPIs. Is there a preference from venture capitalists around KPIs versus business plans?
Okay, so the way we look at it as OKRs, objectives and key results. Our objective this year is to go from 2 customers to 20 customers, okay? And then how are you going to get to that objective? I'm gonna add 2 customers every single month for the whole entire year, and that's how we're gonna get to 20. So you get your objectives and your key results. Great. What is your objective for monthly burn? My objective is to set our monthly burn at $50,000 per month. So I'm gonna lose 50, 50, 50, 50, 50 for the whole entire year. What is your customers? What is your ACV? What are you charging for your product? I'm gonna be charging $10,000 a month for the product. So every time I add a customer, I'm adding $10,000. And you measure that out for the whole entire year. So you set your objectives and you set your key results under those objectives to measure that over a period of time. And then if you can adopt that strategy, trust me, and you can adhere to it and deliver that to your investors, all the investors are able to understand what you're doing, where you're going, and if you measure it over time, they will really have a clear view of what you want to do. And then, you know, I don't care whether or not, you know, your ideas today are going to plan out. We just want to measure it so that we can look back at it in September and say, well, how are we on the 20? Oh, well, we only have 2 customers. We lost everybody. Or we're at 40 customers. We're way above it. Or we're experimenting with our pricing. We were doing 10,000, but I've actually quoted 20,000 to a couple of people, and no one has a problem with it. So we're actually doubling the amount of, you know, ACV we have. Or, you know, hey, we're getting towards profitability, so our cash burn is no longer $50,000 per month. It's more like $10,000 per month, and we're driving towards profitability. We'll be profitable in January. If you can understand your business and then you can report on it over time, then we as the investors have a clear vision for where that company is going. And I will tell you that the companies that are really able to do that are our most successful companies. And the ones that do not have any clue on what they are doing or are too lazy to do it, and I'll say laziness, it's laziness, or they are just clueless as to like what is capable of making their company successful, we can't invest in them because we cannot build a long-term relationship with that business because they don't even know what they're doing. They're only looking to raise capital. They're not looking to grow a business effectively. So it's that accountability layer that we have to build into the system like day one in order for us to make an investment. Is that it? My voice done? Any other questions? Last call? Well, it was a really pleasure talking to you guys. I'm usually around whenever UWT has me. Look us up on LinkedIn, Dennis Joyce. Ask us lots of questions. Go to tacomaventurefund.com and follow what we're doing. We usually have the logos of all of the investments we make, so you can check them out. And don't be a stranger. Our whole goal is to build up the ecosystem of our area. My advice is if you're building a company, talk to us early and realize, it's a longer term build towards a relationship and towards us investing. If you're starting a company, ask lots of questions, be curious, and then let's build some great companies. If you're an investor, give us some cash, and let's really get somewhere with this ecosystem.
Thank you very much. Right, thank you so much, Dennis. I just want to bookend us. The competition, just a reminder, you can register or enter on our website. Submissions are open until a week from today. And we also have phase 2, more details coming on that, that will open in the summer. In which same thing, new piece of financial technology to help people better manage their finances. But this round will be open to anyone that lives, works, or studies in Washington State, and it will be for a $10,000 prize and a 6-month membership to CoMotion Labs in Seattle. You should enter.